The S&P 500 just hit the 100th percentile, and the S&P at this level has historically marked a regime inflection. Something is breaking beneath the surface, and the data confirms it. Right now, the S&P 500 is at 7,041.3, the 100th percentile for the past year. Historically, the S&P at this level has historically marked a regime inflection, says the data needs to confirm. The commodity analyst says, we are in a commodity supercycle driven by underinvestment and deglobalization. In the next few minutes, I will show you who the data says is right and what it means for your money this week. The commodity analyst has been right for 117 straight days. Here is the full scoreboard. The commodity analyst called it commodity supercycle. Oil at $88 confirms it. 117-day streak. Gammon is right and the data keeps proving it. Investment grade spread at 80 basis points. 4 days running, the volatility experts' volatility expansion call is paying off. VIX at 18.2 and trending their direction. 4 days running. Too early to call McElroy right or wrong. The thesis is building but not confirmed. 116-day streak. Hartman might be right, but the data has not confirmed the thesis yet. 110-day streak. The dollar analyst might be right, but the data has not confirmed the thesis yet. 6 days running. Snyder is wrong, for now. Yield curve at 0.54% is moving against the thesis. Score today, 3 right, 3 early, 1 wrong. A streak this long means the trend has legs, but long streaks end eventually, and when they do, the reversal is sharp. Today's big question: are commodities in a supercycle, or is this the top? On one side says the data needs to confirm. That is the setup. Everyone hears it on the podcasts. It sounds convincing. On the other side, the commodity analyst says we are in a commodity supercycle driven by underinvestment and deglobalization. Two smart people, opposite conclusions. So who is right? Here is what makes this interesting. Oil is falling while gold is rising. Those two signals should not be going in opposite directions. When they diverge like this, one of them is lying, and the resolution is usually fast. Oil at $88, 89th percentile, down 7.1% today. Gold at $4,806, 84th percentile, 84.4% today. Copper at $6.04, 97th percentile, down 0.4% today. Bottom line, the data is split. Neither side has a clear edge, which means the resolution is coming soon. If oil drops below $80, the supercycle calls in trouble. Right now, it is at $88. If copper breaks to new highs while oil falls, it is demand rotation, not a supercycle. Oil at $88 is in the 89th percentile, reversal territory. If it drops below the 75th, the thesis weakens fast. Gold at $4,806. We'll track it daily on the scoreboard. Phase 1 is the good times, but good times do not last forever. Here is how close we are to the edge. We are 70 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points, currently at 80 basis points. Pace is flat or improving, no urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has yield curve, initial jobless claims flashing red. Gammon says the Fed is breaking things and credit spreads will blow out. The data agrees with that assessment. Phase 1 holds with 70 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here's what the ZIP level data is screaming about today. LA days on market is spiking in HOMA. Days on market in HOMA moved plus 100% in 30 days, now 248 days. Buyer leverage score 5100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. AR, days on market, is collapsing in Harrison. Days on market in Harrison moved 99% in 30 days, now 107 days. Buyer leverage score 4600. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. New York, NY, payment burden is past the breaking point. New York, NY, median home about $738,000 on about $38,000 household income. Price to income ratio 19.3. When the math stops working, sellers find out before buyers do. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, are commodities in a supercycle, or is this the top? Let me show you what happened the last time we were here. Copper at $6.04 is in the 97th percentile. That means it is higher than 97 out of 100 days in the past year. In 2022, copper dropped 35% on China lockdowns and global recession fears. In 2020, copper crashed in March, then doubled over the next year on stimulus demand. In 2011, copper peaked above 4.60, then gave back 30% as China growth slowed. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, oil at $88 is in the 89th percentile. The last time both copper and oil were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. History does not pick a winner here, but it does say the resolution is coming soon. Be positioned before it arrives. Here's what the data says to do right now. Do not chase the S&P 500 here. The 100th percentile is reversal territory, not an entry point. Avoid Denver at 36% payment burden. That is stretch territory. Phase 1 holds. No alarms, but the runway at 70 basis points is shorter than last month. Every signal is live at analyze.builderslens.com. The podcasters give you the thesis, we give you the scoreboard. Subscribe, and I will see you tomorrow morning.